It is always essential to recognize the ones who always support us. Let us recognize our sponsors. Thanks to our title sponsor, Saudi German Health, principal sponsors, Pan Emirates, Home Furnishing, AGMC, Tele, Lulu, and IFCO, Platinum sponsors, Emirates Chartered Accountants Group, WMS, Cloud Soup, and UHY James, FMCG partner, Aktia, media partner, Khalid Times, institutional partner, Delhi Private School, banking partner, Bank of Baroda, and magazine partner, Finance World. Let us appreciate our sponsors with a big round of applause. Thank you. Ladies and gentlemen, I am sure that today we will gain a unique experience by interpretation of the key aspects of the law and its modalities, which should sharpen our skills for the implementation of the corporate tax in the UAE. The law has made some of the provision liberal, like capping on interest expenses of 30% of EBITDA. As per PCD, public consultation document, it was capped at 30% of EBITDA and there was no carry forward. Now, remaining portion of the interest can be carried forward up to 10 years, though it is important to see, in EBITDA, what is A? Amortization. In year 1, what is available for amortization? This is the important part which is missing. Depreciation, interest, those are available, but A is not available. So definition of amortization, which we need to see. Similarly, there is now more focus and clarity in terms of permanent establishment and POEM. There is another simplicity of free zone person as well. Article 2 provides relaxation in terms of zero rate tax on qualifying income. So if a company who is dealing in free zone and mainland, there are chances that only certain portion can be treated as zero rated. Another interesting aspect, any idea that how this corporate tax law has affirmed the ESR requirements? Which we thought that ESR is just a submission, government will share the information with foreign countries and all. But they affirm again in this law, and especially in terms of free zone entities, to make it more simpler. So Article 18, exactly, substance. Article 18 came up with ESR requirements that presence in free zone will not suffice a free zone person to demonstrate the adequate substance in the state. So we can think that what is the future of offshore companies without their physical presence or without ESR compliance. Also, I hope that this time free zone should be the same as declared free zones, unlike VAT designated zone. Because before VAT, I don't think so anybody is aware that there are free zones in Al-Khuz and Al-Gises. So that is the reason they have mentioned free zones, not the designated zones. And without taking much time, let's hear from our expert, Mr. Abhiman Joshi, on the applicability of corporate tax, its coverage, and the exemptions available for extractive and non-extractive businesses, whether these are available for ancillary service providers to these businesses or no. Because if you know, in VAT, the ancillary services provided to international transportation of goods and services, those are also zero rated. Whereas law specifies that contractor, subcontractor, ancillary services are not qualified for the exemption. So let us hear from our speaker, Mr. Abhiman Joshi. And to introduce Abhiman Joshi, I would like to invite our Vice Chairman, Sri Harikishan Rakawat, to the stage.
Good afternoon, ladies and gentlemen. I know now we are back to the school in DPS, and that too for the corporate tax law. So again, we have become students. And this is post-lunch session, so you guys would have already got tired and we have to be awakened. And for that, I would like to do one exercise. You guys have your mobile? Just take it in your right hand. And then with your left hand, you can put your mobile on Manmohan Singh mode, silent mode, please. Okay. Do you guys remember that on 9th of September 2009, what was the special in Dubai? Metro. Very nice, sir. And friends, Number 9 is very lucky for us. If you remember, corporate tax law was introduced on 9th of December, and rate of corporate tax is also 9%, exceeding 375,000. And you guys have 9 months to submit your CT return. Waiting is over because corporate tax law has come, but waiting has started for executive regulations. So we are waiting for that, and I hope by 9th of January 2023, you will have a gift executive regulations. Friends, you guys are aware that tax calculation is very easy, but to find out the taxable profit, there are so many allowances, disallowances, so that is very difficult. Now, I think Manoj has already touched upon free zone and mainland companies. That will be a big challenge. I mean, there will be a lot of debate on that. Then qualifying income approach, still we have to wait and watch. There will be a lot of questions from you guys, and there are a lot of experts. So let's see, I mean, we will hear from them and we'll get our queries resolved. If not, then we have to wait till the next year once executive regulation is out. But one thing we have to keep in mind now, corporate tax law will be implemented from 1st of June 2023. But GAR, General Anti-Avoidance rules have already been kicked in, 15 days from the date when the notification was issued for the corporate tax law. So now if you change anything in your company structure or your financial year, or any changes in order to do your tax planning or whatever so-called, so you have to be very careful and you have to justify with solid, rational, you need to have proper backup documentation. Now, I would like to introduce our first guest speaker, Mr. Abhiman Joshi, who is currently working with Deloitte UAE as business tax partner, and he is currently focusing on UAE corporate tax regulations. Prior to UAE, he has worked with Deloitte Qatar for 3 years, focusing on business tax compliance, tax advisory, and tax due diligence for MNCs. Prior to Qatar, Abhi was based in Washington, D.C. He has 17 years of experience on US income tax, multilateral instruments, permanent establishment, and tax treaties analysis. Abhi has worked extensively with both public and private sector, private equity funds, high net worth family offices, telecommunication clients, and sovereign wealth funds. He has advised large MNCs on BAPS and OECD, country by country reporting, master and local file preparation. He has conducted a lot of tax events on OECD, Pillar 1 and Pillar 2 developments. Abhi is currently pursuing his LLM in International Law and Foreign Affairs from Hamad bin Khalifa University, Qatar, and he has also done Masters in Taxation degree from American University, Washington, D.C. Abhi is a CPA licensed from Virginia Board, and he is a member of AICPA. Please put your hands together to welcome CPA Abhiman Joshi. From this side.
Good afternoon, ladies and gentlemen. Thank you, Mr. Hari Krishnan, and thank you, Mr. Manoj, for the kind introduction. I haven't heard that long introduction for such a long time, so I was a little bit more shy hearing all this thing. But it's a pleasure to be here with all of you today, and I'm surprised that even Saturday, we all took our time and energy to be here with all of us. And I am personally honored and thrilled to be in front of so many CA members, like yourself, because I know that CA is the toughest degree to have, even more than the US CPA, because I know that because my dad also did the articleship for the CA. He didn't complete it, but he did it. So I know all the horror stories of completing the CA. So it's really my true honor to be in front of you today. So let's see the clicker. Okay, perfect. So obviously, I personally wasn't expecting the law come out this last week because this law was supposed to be coming out September, October. Clients were asking me, when is it going to come out? You know, if I were to bet my house, I would have been bankrupt so many times, you know, because they were keep pushing. And then here the law came out last week, and we were all very, very busy. We just had a lot of conversation with our clients. I was also happy to see some of our clients here in the stage today. So, as a quick background, right, so we all know the details of the law. My goal is not to go over each and every single detail, but just talk at a very conceptual level, at a very high level, the key points. So first of all, as a background, we all know that UAE is part of OECD's BEPS Inclusive Framework member country. OECD is the Organization for Economic Cooperation and Development. It's a membership of 140 countries where UAE is also part of it, right? And last year, when OECD introduced the global minimum tax of 15%, UAE was also a signatory to that. So it's one thing for UAE to sign a global treaty, but not do anything back at home. This is exactly one of the reasons why UAE has introduced the corporate income tax. Mostly to be in line with the international standards, to no longer be considered as a tax haven jurisdictions, because as you know, at some point, UAE was also gray listed by the European Union. So that's all that done. We are looking at the new horizon. We are looking at the new horizon, in the future. So here, basically, back in December 9th was when the federal law, decree number 47 of 2022 was released. But it's funny because no one in the community knew that the law, the Arabic law, was actually issued in October 3rd, and the effective date, and the publication in the Gazette was basically 10th of October, right? And it would be effective 15 days after, which would be, and I don't know if you can see the screen clearly, but if not, I can just go over. But basically, it would be effective from October 26, 2022, except for the GAR provision, which is the Article 50. It would be effective from October 2022. Now, we have so many multinationals here that meet the Pillar 2 threshold as well, meaning Pillar 2 threshold means any companies with a global revenue of 750 million euro. And I see a lot of questions from our clients who meet those thresholds. What's going to happen to my company? Will it be 9%? Will it be 15%, right? That was a lot of back and forth going on when the public consultation came out. It turns out that based on what the law says, it says until UAE implements the Pillar 2 in the near future, we don't know when, but right now, all you have to worry about is about the two tax rate. 0% for income less than 375,000 dirham and 9%. So that has been quite a relief for large multinationals, but of course, you also have to account for Pillar 2 down the road. But today's topic is not about Pillar 2, it's mainly about the UAE corporate tax. So here the framework is basically, so we have Pillar 2 starting, well, we have the law starting from Jan 1st, 2024, and actually the Pillar 2 is also going to be effective from 2024. I am delighted to share with you about the quick update on the Pillar 2. Just recently, a few days ago, European Union has finally unanimously agreed on the implementation of the Pillar 2 at the EU level. So they have agreed to issue the directives, and all the European countries now have to transpose the OECD Pillar 2 rules into their national rule by end of 2023. So it's so surprising that the UAE law is similar to the timing of the Pillar 2 rule here as well. So here, the Article 11 basically talks about the legal person, right, who are basically subject to the UAE tax. The legal person, the foreign legal person effectively and managed and controlled in the UAE, and a natural person who conducts a business. One point I would like to mention is the foreign legal person effectively managed and controlled in the UAE. I'll give an example. Let's say we have a UAE multinational company, they're headquartered here, but they may have a presence in, let's say, Thailand or Singapore, where they may have a subsidiary, but it's effectively managed and controlled here, meaning the headquarters is here. So, one of my clients called me, so what does that mean? Does that mean this, my company X in Thailand, whose headquarters is here, does it also have to potentially file the UAE tax return? I mean, if you purely read the letter of the law, Article 11, technically, yes, because the poem is here, right? Place of effective management and control is here. But again, theoretically, it could be a possibility, but let's think about it, right? Practically speaking, what are the chances of it's going to happen? It will be a nightmare that all your foreign subsidiaries, where it's headquartered here from the place of management and control, they would have to file all the tax returns, which makes no sense. So, but again, this is something we have to look into it. And I would tell my clients, don't get worried right now, because one of the things you also have to look at it is your treaty provision, assuming that country and the UAE has a treaty, to see if there is any treaty override that would allow those countries not have to file the return here based on the tax residency rule. Just a quick example. Now, the another interesting example I've been seeing in the law, I don't know if you have noticed, is the issue of the unincorporated partnerships. Does anyone do have your companies that are in unincorporated partnerships or aware? Feel free to, and we can go over the Q&A session later. So, but basically what the unincorporated partnership says, it's similar to the US partnership rule, where it says, if it's a company, if it's an LLC company, whether a free zone or a mainland, we know that we have to file the return. There's no any need for that. But if it's an unincorporated partnership where there is no any legal liability, everything flows up to the partner, then technically speaking, if I am one of the partner in an unincorporated partnership, then the partnership doesn't file the UAE tax return, it goes up the chain. That means I, Abi Joshi, will have to file the tax return and pay the tax on my share of the income. That can be a huge risk for all these natural persons, who gets the income from the unincorporated partnership. So one good provision it says is that unincorporated partnerships can also be elected to be treated as a regular LLC company or a corporate entity, so that it has to file. So I just wanted to share this one of the few caveats here, with you today. So here, obviously we know all the UAE resident company have to file, whether you are a free zone or a mainland, and even the non-residents, such as those who has permanent establishment, derived state source income, or that has nexus, have to file the tax return. So here, basically, we know that as of now, we only have two tax rates, 0% and the 9%. We still are waiting for the cabinet decision of what will happen for those large multinationals. And for the qualifying income for the free zone entities, we don't have the definition of qualifying income at this point. But based on my experience reading with the PCD, basically those could be three types of income. One could be, let's say, free zone income entity getting an income from another free zone company or from outside of the UAE, that's one. Or a free zone company, let's say, getting passive income, let's say dividend income, whatever, that's number two. And, or the free zone company getting the income from another free zone. But if anything else, it may be considered as a bad income, which was subject to 0% rate. Now, when I was reading the public consultation document, my understanding was, if you have a free zone company that has, let's say, two streams of income, $99 of the income comes from another free zone or foreign countries, and 1% income that gets from the another unrelated mainland entity, right? My understanding for the PCD was that $1 income from the unrelated mainland entity can potentially taint your entire $99 of income. That was a huge risk and a concern for the free zone entities. But now it appears that when the law came out, it says a free zone entity can have a combination of good income and a bad income. So for any qualified income, you don't pay any tax. But for the unqualified income, let's say income coming from the mainland or what have you, you have to pay tax at the rate of 9%. So just wanted to point that piece as well for you. Yes. I know Mr. Hare Krishna also mentioned about the exempt piece, and certainly, needless to say, government entities that are not doing any business, pension funds, what have you, they are not, the charitable organizations, they are not subject to tax, and even those extractive business industries, such as in the oil explorations, we know that they were not subject to tax. That we knew that even in the PCD, because they were already subject to the emirate level taxation, right? Now, there was something more added in the provision, something about persons involved in the non-extractive business. My understanding from the law is the definition of non-extractive business is not only the extractive is the oil exploration, the non-extractive could be storing, transporting, some sort of like a downstream operation or things, right? So it looks like as long as those downstream operation companies are also paying the emirate level tax, then technically they are also not subject to the corporate level tax. That's something interesting. It's funny that oil and gas companies, the extractive industries are exempt, but at the same time, we also know that the branch of a foreign banks are also subject to 20% emirate level tax, right? But if you notice, there has been no exemption given to the banks, at least for now. So it looks like the million-dollar question is, on top of the 20% tax, do you also have to file another tax at the rate of 9%? There are so many, there are like 40 or 50 decisions that still need to be made by the cabinet decisions. Plus we have 158 Q&As that tries to clarify. But yet, of course, I would be cautious in advising our clients or talking to the management that we still have to wait for the final executive regulation. That's where the devil is in the details, right? So before we make any definitive conclusion, but at least it's good for us to start having conversation with the management or with our clients if we have those sort of conversations. So let's see here. The free zone, I think, the free zone, right? There are the requirements are you need to be deriving a qualifying income. These should not be subject to the corporate tax. Arm's length principle, and maintaining the adequate substance in the UAE. That's a very interesting point because it's similar to the ESR reporting. So now the question is, just because you are a free zone company, but if you don't have any substance, you're purely a holding company, the question is, does it really become a free zone company, right? Does that mean that if you don't meet the substance, do you have to pay the tax? The meeting of substance is like, you have the relevant activities, the core income generating activities, the whole ESR filing, which I'm sure you're aware of. So this is something interesting provision for all our free zone companies. I'm not going to go over the detail on the calculation of taxable income because I know one of my colleagues will be going over. Plus the screen is not that visible, at least from my side here. So same thing, when I was going through this one, I will only touch upon one or two items that may be relevant of interest to us. One may be quick example of participation exemptions, and the one on the interest expense piece as a quick example for you. So basically, participant exemptions, there are a few criteria you have to meet. If a UAE company is getting a dividend income from another UAE company, the law says it's exempt. That's easy, right? I have a company who is getting a dividend from a bank or insurance company, that's exempt. Now the question becomes, what if a UAE company have a company in a foreign jurisdictions and it gets a dividend income or capital gain? How do you treat it? Is it taxable or is it tax-free? The law says, the Article 23 of the law says that you have to meet two tests. One test is that the UAE company needs to be owning the foreign companies at least 5%, because we have so many companies that have jurisdiction presence all over the world. That's one test. And that foreign jurisdiction needs to be subject to at least 9% tax. So basically, I can give you two scenarios. You have a UAE company owning a company in Cayman Island, and you have a UAE company owning another company in UK. So the UAE company both meets the 5% test because they own it 100%, But you notice that the dividend coming from Cayman Island is not tax-free, is not tax-exempt, because Cayman Island has a 0% tax. But at the same time, the dividend income coming from the UK can be tax-exempt because UK already has 9% tax, right? That's basically the crux of participation exemptions. You need to own 5% minimum. That country where you are investing needs to have a tax rate of 9%. That's the second requirement. You need to be owning involved in the stock for that company for a minimum of 12 months. That's the third requirement. That's a very high-level overview of what the participation exemption, and this is going to be a key provision because UAE is subject to the worldwide income. You don't want to be in a situation where you are picking UAE income plus the foreign income, which is subject to taxation. So it's very important we keep track of this participation exemption point, please. Now, Mr. Manoj and Mr. Harikrishnan were talking about the interest expense piece. So certainly as our clients have, as our companies have a combination of debt to equity ratio, and anytime there is a net interest expense, we have to worry about the 30% of EBITDA rule, right? If you have a net interest expense income position, then you don't have any issue. But if you have a net interest expense situation, it's subject to 30% limitation. Basically, you have a $100 interest expense, it's limited to, and you have an EBITDA of, let's say, 100, it's subject to limitation of $30 only. And when the PCD was out, we didn't know what would happen to the excess $70, but now the law clearly says that you can carry it forward for up to 10 years. So that's a good provision. That way, otherwise, you would be losing that money, for the future. This is another interesting point, which is very, very relevant for all of us, which is the Article 31, the special interest rule. So I have a company, and let's say I'm a UAE company, then I have another Cayman Island subsidiary, and let's say I borrow the related party loan from a Cayman Island subsidiary, my company, to pay the dividend to my shareholder, right? Here, even though it's a related party loan, but the fact that I'm getting this money not for the actual operation, but to pay the dividend to my shareholder, I cannot be getting the interest deduction on the related party loan coming from the Cayman Island entity. But the same situation, make it other. I am a UAE company. I am borrowing money from a UK related party company to pay the dividend to my shareholder. The chance that I should be able to get the deduction for the loan coming from the UK is higher because UK has a minimum of 9% tax, whereas because UK's tax rate is going to be like 23% in April, whereas Cayman Island has 0% tax, right? Because one of the key provisions is when you are acquiring a related party loan to make a dividend distribution or to fund the acquisition, whichever the jurisdictions you are getting the loan from, that jurisdiction also needs to have the equal at least of 9% tax rate. Otherwise, you run the risk of not getting the tax deduction on that interest expense. So certainly this is why, as you are reviewing your org chart, as you are doing the budgeting and the planning and the modeling, in the foreseeable future, especially, I'm sure we all have companies that are based multinational, so we have to look into what's the best approach that would be relevant from a tax optimization perspective. Quickly on the grouping, without going into detail, there's 2 line items in grouping. You can have 20 different mainland entities and 20 different free zone companies. You cannot be mixing the free zone and the mainland for the grouping. All the mainland can be grouped as one. All the free zone can be grouped as one, as long as you are commonly and control more than 95%. That's the key piece of the grouping. But this will certainly make it very, very easy for the companies or for the clients, as they will have to not worry about filing hundreds of returns. They can just make it streamlined. And the other benefit is that if you have a loss from one entity, you can use that loss to offset the profit from the other company. That's a key relevance that is also required, from the grouping perspective. I don't know if you can see the screen, but basically the loss carry forward, it's just a quick example. I have basically a loss. Well, unfortunately, I wish the tax authority had given a grandfather of all those losses for all the businesses that suffered during the COVID time. But unfortunately, those losses would not be relevant. Only losses starting from Jan 2024 would be relevant. So, but the good news about those loss carry forward is that I think we're still trying to get the clarification, but as far as I understand, the loss carry forward might be in indefinite period. That's good, but the only provision is if you have $100 of loss, and if you have $100 loss in 2024, but let's say that you can carry forward to 2025, right? But let's say in year 2025, you have income of $100, right? So you would think that, oh, okay, I can offset my 2025 income of $100 with the loss of 2024 $100. That's not exactly correct, because that loss carry forward is limited to 75% of your taxable income. So you can only carry forward up to $75. You can offset only $75. And the remaining $25 of loss will be carried forward even further, down indefinite period. Now, to me, there were 70 articles, 18 chapters, and all those articles, all those chapters were consistent with how the OECD, the US, and the UK rules are. But to me, as my colleagues were mentioning earlier, General Anti-Avoidance Rule, GAR provision, is one of the most breathtaking and one of the most important provision that we have to keep in mind, especially because of the fact that it has already kicked in starting from October 10th, 2022, which is the publication date in the official Gazette, right? So if you recall, OECD has 15 BEPS action points. And we know that UAE is also a member of the OECD BEPS inclusive framework. UAE has to follow 4 minimum action items. Those are action 5, economic substance, which UAE is already doing it. Action 6, preventing treaty abuse. UAE already has all those treaties and making sure. Action 13, transfer pricing, country by country reporting, which we already have it. And last but not the least, action 14, which is the dispute resolution, because we have all those MLIs. Now, if you ask about me, in none of those BEPS 15 action items, there is a mention of GAR, because GAR is like very objective. It is basically, it's an overriding principle. So basically what the GAR is trying to say is that you can do whatever the tax planning strategy, what have you, but if the tax authority smells like there is not substance, it's, the substance over form, it feels like the pure motive of what you are doing this transaction is purely to avoid tax, then the tax authority can basically disregard that transaction and tax you on that transaction, right? So let me give you an example here. I hope you can see the screen, but I can quickly explain to you. On our far left-hand side, we have a UAE company that has a foreign jurisdiction, let's say Cayman Island, and let's say, it gives a dividend income, right? But as in my participation example mentioned earlier, since the dividend income is coming from a jurisdiction that does not have the minimum of 9% test, you fail that test, and that dividend income in this case is like, how much? 600,000 dirham is basically taxable at the rate of 9% at the UAE level, right? That's the scenario number one. But let's say I try to be over smart and say you know what? So rather than my Cayman Islands subsidiary giving only me the dividend of 600,000 dirham, why don't I make my Cayman Islands subsidiary give a dividend income of, let's say, 300 to me and another 300 to my another sister company, right? So in the second chart, instead of 600,000, the Cayman Island is giving 300 to one UAE company, and the another UAE company is getting the 300,000, right? So basically, I created a UAE company too, purely for that purpose of receiving the dividend income. So here, if you think about it, technically speaking, since you are getting an income of below 375,000 dirham, then technically you are not subject to tax. And even though you're getting a dividend from a less than 9% jurisdiction, you can argue that, guess what? It's tax-free anyway, right? If a UAE did not have this GAR provision, then they would technically have to honor that dividend as a tax-exempt income. But look at the motive of this transaction. It's, the Article 50 Clause 1A and the 1B says, the transaction entered is not valid for commercial or other non-fiscal reasons, which reflects economic reality. And we clearly see the presence of a corporate tax advantage being seen here. So here in my middle diagram here, clearly me, UAE 1 entity, creating another UAE 2 entity to split the 600,000 dirham of dividend into two separate pieces so that I can fall below the 375,000 dirham is nothing more than pure a tax planning strategy. So this is a typical example of GAR that the UAE authority would look at and say, this is not a valid transaction, and boom, you have to pay tax of 9% on the entire 600,000 dirham. So again, GAR is evolving. There's so many OECD guidance out there. We just have to be aware of what those rules are. So I think in the interest of time, of course, transfer pricing, Article 34, 35 talks about the related party transaction, arm's length document. We all know about it. So just being mindful of these. But these are a separate discussion. This requires a separate conversation. And I think I will, in the interest of time, I would want to pause and see if my audience have any questions, before I move to give the floor to other audience. I don't know if I was on time or I have still plenty of time. I wasn't sure. Sorry, later. Okay, well, thank you so much for listening to me.
Thank you, Abhi. It was good insight to know that what is the impact of corporate tax, exempt income, free zones, and practically you summarized a law within your time allotted of 40 minutes. A big round of applause for our speaker. Now I would like to invite our past chairman, Sri Anish Mehtaji, chairman, Sri Anurag Chaturvedi, and vice chairman, Sri Harikishan Rakawat to the stage, please, for felicitation. Now it's time to hear from the one who is leading us from the front. So let us welcome our chapter chairman, Sri Anurag Chaturvedi, to the stage, please, with a big round of applause.
Friends, every morning when we wake up, we have two options. The option number one, that the dream that we see, we sleep with those dreams. Or option number two, we get up, get ready, and go out and cash those dreams. Now, between the cashing those dreams and actual cash, there's an income tax. The corporate income tax standing out there at the 9%. So it becomes reality as we see the the corporate tax law coming into publication, and effective become reality from the 1st June 2023. So that's something which is incredible happen in the year end, and as we anticipated out there. So, respected former chairman of ICI Dubai chapter, C. G. R. Mehta ji, C. Anish Mehta, Vice Chairman C. Sundar Harikrishan Rankawat, my colleagues in the managing committee, and each one of you, a very good evening. बहुत क्या मतलब लगता है सेशन कॉर्पोरेट टैक्स का अच्छा नहीं था. So there is no you either you are in shock or you are not understood anything. So good evening once again. I try to see that. Good evening. Yeah, that's good now. So friends, as we all know that corporate tax has come into picture, it's a great news for all the professionals sitting out here, we in industry, that we are planning our businesses, we are ensuring that the stakeholders' pockets are still hefty enough and heavy weight, or being a professional to safeguard the client interest. This kind of development hardly happens in one professional's lifetime. And we are fortunate to be here in UAE when we witnessed 3 different or 4 different legislations starting from 2017 when the excise came in, VAT came in, economic substance regulation came in, anti-money laundering came in, the data privacy comes in, and now the final corporate tax regulation. So I think this time is of high precedence. And all is required, and the onus on each one of us is to understand and comprehend the law so that we not only advise our client professionally, but at the same time we are able to serve our purpose of our ICAI Dubai, which we are member of. It's a time to raise the reputation of the profession, and the reputation of profession lies in each one of you and friends. We need to act very diligently. I'm not here to give you lecture, but then I can only say that, we all need to act very diligently today. As the law comes in, all what we need to do that we need to read every single word of the law. Do not circulate the law just like that. Do not circulate the information just like that without you have a trust. No matter whoever is sending you information, at least before passing into next person, who you trust, has a lot of reliance on you. So all my appeal to each one of you is that whenever you talk to somebody, talk in a sense that they can trust the information that you're passing on, because it's very sensitive. The corporate tax is very litigated. Across the world, 75% of the cases approximately, I'll not say exact number, 75% of the cases are in relation to deductions that people claim in income tax, right? And the same thing, if you see that essentially, the transfer pricing provisions, which is now new to the region out there, every businesses need to start evaluating and take the measures very seriously. Because here from, you'll not have time. You'll not have time, friends. The reason is, the record keeping in the corporate tax is 7 years, which means any transaction can go and identified and questioned within the period of 7 years, and who knows? At the end of 7th year, the Federal Tax Authority comes with another amendment saying that, look, if we open a particular case, I can give myself another 4 more years or 5 more years. So this 7 year can become 11 years or 12 years or 13 years. So essentially at any point in time in corporate tax world, a transaction that have been done can be subject to litigation. So my appeal to each one of you is that being a responsive professional, evaluate the information before you pass on. I think this is what the message that I want to pass on. And I would like to really encourage and honor all the speakers who have taken their time out in a very short span of time. I do understand that this event we planned just in a week time because the law came in and we wanted to disseminate and decode the entire law along with all of you. So the timing was there, and considering the FIFA World Cup is ongoing, there's a marriage season, there's a Christmas season, the hotels availability are a huge challenge. So I think you can give a round of applause to our managing committee for organizing this time. and for each one of you for participating in this particular session. So without a further ado, I would like to ask our secretary to take the proceeding further. Thank you, Manojji.
Thank you, Chairman Sahab. Now it's good that in VAT we need to maintain the books of accounts for 5 years. Now it's 7 plus 1, so now total 8 years. Now next important topic is corporate tax computation. What are all expenses are allowed, what are the limits, interest, how to reduce the tax paid in foreign currencies, means foreign jurisdictions, like foreign tax credits, or is there in some withholding taxes and all. For that, we have with us CA Pratim Sen Gupta. He is an associate director leading direct tax practice at Anderson in the UAE, serving a diverse client portfolio in the region with the help of experienced, agile and dedicated tax professionals. With 11 years of experience in providing solutions in all the facets of corporate and international taxation to a diverse client portfolio of large multinationals based out of India, USA, Japan, Spain, UAE and Australia, Pratim previously worked as a senior management position in one of the big four in corporate and international tax practice. He has extensive experience in leading direct tax assignments involving tax compliances, advisory, structuring, representation before tax and government authorities, tax litigation, dispute, and assignments. So let us welcome with a big round of applause CA Pratim Sen Gupta.
Hello. So before the presentation begins, just want to give you an overview of what I'll be talking about tax computation and why it's so important. I believe that there are 4 pillars to any revenue act. A revenue act is any kind of tax act that be, a corporate tax law or an income tax law or a VAT law, and it requires 4 things. Who to tax, that means who would be covered by the tax law, how much to tax, like what income and how to compute it, some exemptions, and at what rate to tax. A very key important part I'll be covering is tax computation, that is how to compute a person's income when they're covered by corporate tax law. With this, I begin my presentation. Okay, the screen's not very clear, so so the starting point, the law says that the starting point is the accounting income as per adequate financial statements. Now, you have your profit and loss as per your financial statements. You have to make certain adjustments that could be allowances or deductions to arrive at your taxable income. Once you compute your taxable income, you have to see whether you're above your threshold or not, and then compute a tax amount, then take credits. That would be your withholding tax credit, foreign tax credit, any other credit that that is issued through a regulation. Now, one key important part that I mentioned in the initial phase was adequate financial statements. The law, the way it's written, it appears that those financial statements have to be prepared on accrual basis. Cash basis is only allowed for certain small taxpayers or for certain entrepreneurs, but that is coming out of the FAQ, but not the law. We have to wait for detailed regulations for that. Also, one important fact is that those financial statements have to be prepared as per accepted accounting principles and standards. In UAE, we are all aware that is IFRS, and we need to wait for regulations if they are, if they're okay with anything else or not. So with that, so basically your starting point is your accounting income. So what are those adjustments that you have to make? One is exempt income. If your income is exempt, I'll touch upon this later. You exclude it from your accounting income. Reliefs, any kind of relief. So some of the reliefs that are covered are small business, small taxpayers. Again, that has a threshold. We are yet to wait for, the regulations as to who will be the small taxpayers. Then deductions. Deductions means any kind of expenditure, tax losses, unrealized gains or losses, transfer pricing adjustment. This is very important. So if transfer pricing is applicable to you and you have any transaction with any related party that's not at arm's length basically means that you have to price it at terms and condition that those transactions would have been priced at if you carried them out with a third party. And, very interestingly, it appears that the law will also give some incentive to qualifying business activity. We need to wait for what this qualifying business activity means. I wonder, because I come from a jurisdiction where we had certain profit-linked deductions back in India, where if you carried on manufacturing, a plant or carried out some activities from certain regions, you would get a deduction for the profit made from that undertaking. Moving on, I'll deep dive into what all these adjustments are. The first one is exempt income. The previous speaker spoke about these conditions. So first being dividend income. So there is domestic dividend and then there is foreign dividend. Domestic dividend basically means any dividend that you receive from a domestic entity in UAE. If you receive that, there are no conditions attached to it, it's exempt. You don't have to see anything more than that. If it's a foreign dividend, and if it's also a capital gain that you incur by selling shares of an entity, and this entity doesn't have to be just foreign, it could be a domestic entity too. So foreign dividend and capital gain from sale of shares, whether domestic or foreign, would be exempt subject to certain conditions that are called participation exemption conditions. As the name suggests, you need to participate in that company in order to get the exemption. What are those participation conditions? You have to own at least 5% of the shareholding in that company. And it's not only ownership. You also have to have a 5% rights in the profit of that entity and also the right in the proceeds if that entity got liquidated. So this is an addition from the public consultation document. So it just cannot be a 5% ownership. Then again, my peer, in the previous session said that you have to hold this interest for at least a 12-month period. But the law also says that if you have an intention to hold, you just don't need to hold. So at the time of filing a return, if 12 months have not gone by and you have an intention to hold that shareholding, you can take that income as exempt income. I'll show this to an illustration. And the third key condition being that entity needs to be at least taxed at 9%. So three key conditions, that is 5% ownership interest, you need to hold that interest for 12 months, and that entity or where you have a ownership interest, you need to hold that interest for at least, that entity needs to be a tax-paying entity of at least 9%. Any foreign exchange gain or loss, or any kind of impairment gain or loss on that 5% shareholding would also be exempt. So it's not only the income from dividend or sale of shares, even the foreign exchange gain and loss or the impairment gain or loss would be exempt. So if you are also a UAE entity having a branch outside UAE, you have an option to exclude that branch's income while filing your tax return. But this is also subject to certain conditions. That branch needs to be in a country where there is at least corporate tax of 9%. And because you would have paid taxes on that income of that branch in that foreign country, you cannot claim a credit of that tax because you're taking it out of your income in UAE. And also non-resident entities that are in international shipping or international airline industries, they're exempt. This is standard across all jurisdictions across the world. They are usually taxed in the country in which they are resident of, not in any other foreign country. Now coming to illustration, so say you have a UAE mainland entity, it holds, okay, the screen is not very visible, so it has 3 shareholding. One, the first shareholding is of a UAE entity and it has a 4% shareholding. The next shareholding is of an Indian entity and it has 10% shareholding of the Indian company. And it has 100%, the third shareholding, it has a 100% shareholding of a Bahamas company. Now when I'm looking, so assuming that all 3 entities give me, dividend income, how would I look at various conditions to see whether they're exempt or not? Now, for a UAE company, I only own 4% of the shareholding. Am I supposed to look at any conditions? No. It's a UAE domestic company. If it pays me any kind of dividend, it would be exempt. There are no conditions attached to it. Now, if I now look at my Indian shareholding, India would be considered a foreign shareholding. I own 10%, so I satisfy the minimum 5% ownership interest that I need. And India, as we are aware, has a corporate tax rate of 25 plus on entities. So it also satisfies the condition that the subsidiary needs to be in a region where there's at least a corporate tax of 9%. So I've satisfied the main conditions, and any dividend that I receive from India would be exempt. And coming to my Bahamas entity, even though I own 100% of the shareholding of the Bahamas entity, Bahamas doesn't have any corporate tax. So because it doesn't have any corporate tax and it's in a tax haven, you would not get any relief or any exemption from any dividend paid by this Bahamas entity, even though you own 100% of the shareholding. Now remember I spoke to you about this, this condition about holding this ownership, of the subsidiary or your investee entity for 12 months or having an intention to hold that interest for 12 months. I'll explain that through an example. Say your first year of your taxable year is from January to December 2024. You acquire the shares of an Indian company on 1st December 2024. Your tax return is due in September 2025. That is 9 months from when you had acquired these shares. Only 9 months, 12 months have not elapsed. But the law says that even if you have an intention to hold that shares for 12 months, you can possibly claim that, any dividend that is issued by that Indian company as exempt. So you go ahead and claim this income as exempt. So, you might have an intention to hold it at the time of filing the return, but say come October 2025, a party comes to you and makes you an offer for that company and you sell the shares of that entity. Now, in reality, while you've claimed that income in 2024's tax return as exempt, but you've not held the shares of that entity for 12 months because you've sold that shares in 10 months. What happens then? Basically, you have to offer this income that you have claimed as exempt in the previous year in the year in which you sell those shares. So in 2025, you have to offer that income to tax. Now, this example, it's not very clear, so I'll just take it through. So if you have, say, a UAE mainland entity holding an entity in Bahrain, we're all aware that Bahrain doesn't have a formal corporate tax regime. Some taxes apply to some industries in the oil sector. But say it's in a service, it's a holding entity for the UAE company. So Bahrain, in turn, holds interest in a Singapore entity. Singapore, by the way, has a corporate tax regime of 17%. Then it has, it holds interest in an Indian company, and it also holds interest in Bahamas. Now, UAE company, 100% shareholding in Bahrain. Bahrain in turn holds 3 entities. That is in Singapore, India, Bahamas. So the law says, if you look at the law just plainly without reading the fine text, you would think, okay, Bahrain, because it doesn't have a corporate tax regime, if it issues dividend to me, I would not get an exemption of the dividend. But the law also provides that if Bahrain company's principal objective and activity is the acquisition of shares, and its income is substantially derived from the income of these, from the shareholding, then Bahrain company would not have to satisfy the condition of being in a country where there's minimum tax of 9%. But I say this with a rider because this whole wording of principal objective has not been defined. What does principal objective mean? Does it mean that I have 3 objective and principal objective should be 75% of my total objective as a company? It's very subjective. So I need to look at, it's very subjective. Further analysis is required. Again, one more condition to get this, exemption is that substantially my income needs to consist of income from, my other shareholding. What does substantially also mean? Does it mean 50% or more? Does it mean 70% or more? Or does it mean 90%? So these are all very subjective terms. But if Bahrain company meets those conditions, then even if you have shareholding through an intermediary, which is not there, which does not have a corporate tax of 9%, you can still get a participation exemption. Now coming to deduction, this is very important from a UE perspective. So there is a general provision that has been provided for deductions, which is very akin to what is there in the Indian law. So other than what they've done is they've given a general provision that what all principles expenditure should satisfy, and then they have covered certain expenditures that will not be allowed. So any expenditure that is not specifically covered by any kind of limitations would have to satisfy these conditions. One is that it needs to be incurred wholly and exclusively for the purpose of business. It cannot also be, capital in nature. It cannot be incurred for earning any exempt income. And if it's of a dual nature, by dual nature I mean that if it's incurred for exempt and non-exempt, then you can claim that expenditure on a proportionate basis. So 3 key conditions: wholly and exclusively for the purpose of business, it should not be capital in nature, and it should not be incurred for deriving any exempt income. These may appear to be very simple, but it can get very complex because, what is a capital expenditure, what is a revenue expenditure is a highly litigated topic across the world. There are so many edge cases, like, for example, if you buy a software license for 1 year, right? Sometimes tax authorities across the world even argue that that is capital in nature. Again, say, if you're implementing a complete ERP package, which you capitalize in your books, there is a clear-cut case of a capital expenditure. But what is capital, what is revenue, has been highly litigated across the world. Another key part is, what is expenditure incurred for deriving exempt income? So imagine that you have people in your staff that make decisions for, investment decisions that are located in foreign jurisdiction, and you get an exempt dividend or capital gains from those jurisdictions. What if they make those investments, but no income is earned during the year? Do you still disallow some expenditure of theirs? What happens then? Because the word that is used is deriving exempt income, not derived exempt income. So this is also something that you need to think about. So when you don't even earn exempt income, are you still supposed to disallow some expenditure? Third, there is no mention about depreciation. How do you claim depreciation? What are the rates at which you claim depreciation? Would depreciation also be allowed for intangible assets? The law is still silent. We need to wait for the regulations. And what about, if you're setting up a new business, what about preliminary expenses? Would that be capital in nature or would that be revenue in nature? These are a lot of talking points and a lot of gray areas that one needs to analyze before taking a deduction. Moving on, what are those? Some of those expenditures that are not allowed. One is donations, grants or gifts given to a non-qualifying public entity. What is a non-qualifying public entity? It's been defined in the law, something like a charitable, a religious, or an educational institute. If you don't give to a non-approved qualifying public benefit entity any kind of donation, that donation will not be allowed. Any kind of fines and penalties would not be allowed as deduction, other than any payment or any compensation paid for breach of contract. Why is this excluded? Because across the world and courts everywhere, view a breach of contract or any compensation that is paid for a breach of contract as a contractual payment and not a fine or not a penalty. Now, also if if there's any bribes or illicit payments, it will not be allowed as a deduction. Any dividend or profit paid or any withdrawals made from business would not be allowed as a deduction. The logic behind it, that is that those are usually payments made after paying tax. You cannot get a deduction for something, it's logical that you don't get deduction for dividend. Now, any corporate tax that you have paid, you will get no deduction for. Any similar taxes that you've paid outside UAE, you will not get that deduction as well. You can claim that tax as a foreign tax credit, but you will not get it as an expense deduction against your income. Any recoverable VAT is also not allowed. Now, the next point is very important. Any entertainment, amusement, or recreation expenditure incurred for customers, shareholders, suppliers, or other business partners would only be allowed up to 50%. They have come out with some suggestive or illustrative list as to what these expenditures are, like meals, travels, accommodation, but that is an illustrative list. And we need to wait whether the authorities issue a more deeper guidelines or regulations for this entertainment expenditure. We are aware that VAT has a clarifications with regard to entertainment expenditure, whether that can be borrowed for interpreting what is to be allowed and what is not to be allowed. We need to wait and see, because this might have a major impact, because we are aware that how, for business purposes, you have to take some clients, some customers out for lunches, meals. It appears you can only get 50% of that. And any interest expenditure, I'll get to that is subject to capping of 30%. I'll get to that in my next chapter. Now, interest capping. So, like my peer had covered, it's subject to 30% net interest expenditure. Is capped at 30% of your EBITDA, accounting EBITDA, that's the word used. So it appears that they will go by the financial statements for calculating EBITDA. And while calculating EBITDA, interestingly, you have to also exclude the exempt income. This could, create some complexities while calculating the threshold. I'll explain that in an example. So what if if you have the 30% comes to, say, for example, 1,000 dirhams, and and you can only get a deduction of, say, 750. What do you do with the remaining 250? You can take that 250 to the next year. It will form part of the interest deduction for the next year, and you can get a deduction of as long as you meet the same condition of 30%. Now the regulations will also come out with a minimum threshold. By minimum threshold, I mean that, say, your 30% of EBITDA comes to 1,000 and the minimum threshold is 1,500, you can get a deduction of 1,500. But what is this threshold is yet to be out. Usually across the world, this threshold is not too big. Experience shows us governments don't give a very large threshold, when they're prescribing it. Now, interestingly, this interest capping is called thin capitalization in the tax world. This has come about from the OECD project of, limiting profit shifting between related party borrowings. So what happens is, let me explain to you. Say you have a entity in a low tax jurisdiction, it will give a loan to an entity in a high tax jurisdiction. Now, this high tax jurisdiction entity now has taken this loan, will pay interest, will get a deduction for this interest, and would obviously incur a lower income, corporate tax on it. While paying that interest to that low tax jurisdiction, that the entity in the low tax jurisdiction would not pay any tax on that interest income. So to curb that and to create a limit on how much interest expenditure this entity in a high tax jurisdiction can claim as a deduction, they came up with this 30% rule. And this usually applies to related party borrowings. But the law does not cover only related party borrowings. It appears it also covers third party borrowings. So this might be a big hit on industries which are very capital intensive. If you have borrowings from a bank, it might cover that also. In every other country, including OECD countries, these laws and limitations are on related party borrowings. But from these rules, it appears it also applies to third party borrowings. So that could have a big implication. Now, I had mentioned this excluding exempt income from the calculation of EBITDA. So assume that you have an exempt income of 40 and you have an interest expenditure of 50. Now, out of the 50, 20 has been incurred for earning exempt income and 30 for earning taxable income. So ideally, you would disallow 20 because the law tells you that any expenditure that has been incurred for exempt income, you disallow. But if I come to my tax computation, say assume that your EBITDA is 200. I reduce my exempt income 40. I come to my EBITDA less exempt income at 160. What is 30% of 160? It is 48. 48. Okay? So now I have a total interest expenditure of 50. 20 has been incurred on exempt for earning exempt income and 30 for earning taxable income. Ideally, I would have disallowed 20. But as per the computation provided, out of 50, I can get a deduction of 48. So there's a difference, and then there seems to be a mismatch in the computation mechanism where actually I can get a higher deduction by excluding the exempt income from my EBITDA and calculating 30% on it, and then by not just disallowing the 20 AD from my, wholly from a tax computation. I don't know, this seems like a gap. We need to wait whether the government plugs this or not. Now, if you have, now coming to related party borrowings, if a related party provides a borrowing or a loan to another related party, and that related party uses that borrowing to make a dividend distribution, or to make a profit distribution, or to acquire shares of another entity, or make capital contributions in another entity, that interest on that borrowing is not allowed, unless that borrowing has been done for not to obtain any tax advantage. Now, there is one condition that has been laid down, that it will be deemed that no tax advantage has been got if that related party is in a jurisdiction where corporate taxes at least of 9%. But, this language of corporate tax advantage or tax advantage has been defined in the general anti-abuse provisions, but it's been very widely worded. What it can mean, it's been worded like even if you take an enhanced refund, if you take an additional deduction. So we have to see whether you will be covered by this or not. But any related party borrowings for dividend payment, for acquisition of any kind of capital, you will not get any interest deduction on that. Tax losses, you will not, so one important factor about tax losses is that you will not get tax losses to be carried forward before the corporate tax regime is applicable to you. So if the first year is January 2024, you cannot carry forward losses outstanding 31st December 2023. You cannot carry that forward, the law provides it clearly. But from 2024 onwards, you can carry it forward indefinitely, subject to 75% of capping. So if you have a tax loss of 100 in year 1, and you have an income again of 100 in year 2, you can take that 100 to year 2 and set it off up to 75. The remaining 25, you can carry it forward to indefinite number of years. This is quite progressive. Usually, countries across the world give a limitation on how many years you can carry forward losses up to. Now, what if your ownership also changes? So if your ownership changes of more than 50%, so if you have incurred a loss of 100 in year 1, and your ownership has changed of more than 50% in year 4, you will not be able to carry forward these losses unless you carry out the same or similar business activity. There's a huge, the what is same or similar business activity has been broadly been defined in the law, but again, it's been widely worded. It's very, very subjective. And one needs to analyze in depth. Every case would be unique, and you'll have to see whether you satisfy that condition or not, if there is a change in shareholding. So I have an example here. I'll quickly run past this example. So you have say a loss of 300 in December 2023. You have an income of a loss again of 100 in 2024. And you have an income of 200 in 2025. And an income again of 150 in 2026. Now, the loss of 300 in 2023, you cannot carry it forward. 2024, 100, you will be able to carry it forward and set it off against the income of 100 in 2025. Income of 200 in 2025, but up to 75% of 200. 75% of 200 is 150. And you have a loss of 100, so you can set it off completely. There is no limitation, and you have no loss remaining to be carried forward to 2026. Now, in case number 2, you have a loss of 175 in 2024. Again, an income of 200 in 2025. Now you have what is 75% of 200? 150. Your loss is 175. Eligible income is 150. You can only set it off up to 150. The remaining 25, you have to carry it forward to 2026. And move on to the next example. In change of ownership, say, C company is held by A company and B company. A company holds 75% of the shareholding, and B company holds 25% of the shareholding of C company. Now you come to year 3, which is 2026. The shareholding of C company has changed. Now A company from 75% shareholding now only holds 45%. B company from 25% shareholding only holds 10%. While D company has become a new shareholder in C company of 45%. Would you be able to carry forward losses from year 1 to year 3? You would be. Because A and B still hold shares of more than 50% in C company. They still hold 55% of the shareholding in C company. That is why you still carry forward the losses in C company. Now coming to, I'll just broadly take you through transfer pricing, because transfer pricing is such a topic that, one can speak for 3 to 4 hours and it cannot be just consumed over 10 minutes. But broadly, it means that, like I mentioned, that any transaction with a related party or with a connected person, I'll get to connected person because it has a huge implication for UAE businesses. So there's a broad definition for related party shareholding of above 50% or a relationship to fourth degree. Fourth degree basically means, in layman's term, up to my great-grandfather or great-grandmother. And it doesn't have to be a blood relation. It can be a relation through adoption or legal guardianship also. So the law covers that too. So if I have a transaction between two related party entities, it'll have to be at arm's length. Arm's length means broadly, at a price and conditions that I would transact with a third party. Now, how do you bring a transaction to an arm's length? You have to carry out a very detailed transfer pricing study to do that. It's called a benchmarking study, where you compare your related party transactions to what prices are usually charged by third parties. Now, once you bring it to arm's length, you have to also do a lot of documentation. In local file, master file, I'll not get to it, but you'll have to also do that. But what happens if you don't bring your related party transactions to arm's length? The tax authorities can make an adjustment in your income, to your income. So say you get remunerated by a foreign company of say 1000 AED in a year, but the arm's length price, so the market value of the service that you're providing to your related party comes to 2000. The 1000 would be added to your income, and you would have to pay additional tax on that addition. So it's a very important aspect for all UAE businesses to take care of. I'll not run you through this example because it is what exactly I spoke about while explaining transfer pricing. Now coming to connected person, why this is so important? Now, who is a connected person? A connected person has been defined as an owner of a taxable person or a director of a taxable person. So an owner and director and their related party. And if you are an unincorporated partnership, the partners and their related party. So if you are making any payment or you're providing any kind of benefit to any owner of your business or a director of your business, you will have to now see what is the market value of the service or the benefit that this owner or director is providing to your business. So if it's not, so how do you determine market value? It is again determined through transfer pricing principles. You will have to see, what third parties price this payment at, but, making an owner, making a payment, say, to a director for director fees, sitting fees. How do you do a transfer pricing? It's quite laborious. You will have to see their qualifications, their background, what benefit they're giving to your company or your business. It's quite a big hit because if it's not at market value, that payment, so any kind of payment that you're making to a director owner, if it's not at market value, that payment would be disallowed. So say you're giving a owner or a director a payment of 2 million dirhams for any kind of service or fees that they are getting, but the market value of the service or the fees, the tax authorities say that, the value is only 1 million. Why are you paying them 2 million? They will make an adjustment of 1 million. It is very important to carry out a transfer pricing analysis of all payments made to directors and owners. If you don't do that, you run the risk of getting a disallowance in your books and your taxable income. So with this, I conclude my session as to the key aspects of computation. I broadly covered, what would be the adjustments made to your taxable income. Any query I would be happy to take post this session. Thank you all.
Thank you, Pratim. It's a good insight that what are all covered to calculate the tax and what are all available as deduction. Now, may I request everyone for a big round of applause for our speaker, Pratim Sen Gupta. May I request our past chairman, CA G.R. Mehta ji, our chairman, CA Anurag Chaturvedi, and vice chairman, CA Harikishan Rakawat ji, to the stage for a felicitation. Thank you very much. Now I would like to invite XCOM for a group photo with the speakers on the stage, please. Executive Committee member of Dubai chapter, Rishi, Dheeraj, Jay, Hariji, Chairman, and all the speakers. Abhiman, Amit, Pratim again, Manu. Now it's time to hear about intergroup and tax group, because here in UAE, most of the entities are working under the group concept, but they do not follow any transfer pricing or any sort of laws. So to decode the complexities with solution, I would like to invite CA Amit Mehta, and to introduce CA Amit Mehta, I would like to invite to the stage our executive committee member, CA Rishi Chawla.
Thank you, Secretary Sir, for giving me this opportunity to introduce the next speaker. All right, good afternoon, members. Thank you for coming all the way for attending this important session. I'm sure you are gaining a lot out of this. This year, actually 2022, is turning out to be a hallmark year. We have so many things coming out of COVID into a year with no masks. Then we have Cricket World Cup just happened. Now we have Football World Cup, which is ongoing. And we have our World Congress of Accountants, another World Cup. And now we have World Cup of Accountants on corporate tax, which I'm sure will keep all of us busy and bring a lot of earnings and a lot of growth in our careers. All right, to decode another important concept in this law, which is intergroup and tax group exemptions and relief, we have a very knowledgeable next speaker, CA Amit Mehta, who is an associate partner, tax with UHY James. He has over 13 years of varied professional experience across tax, finance, and accounts domain, especially in topics such as corporate tax and VAT. Without taking much time between you and this experienced speaker, ladies and gentlemen, with a big round of applause, please join me in welcoming CA Amit Mehta.
Hi, very good evening, everyone. Thank you. First of all, thank you all for joining us today for this event. And thank you, Mr. Anurag and Managing Committee for having me here again. So, as we all know that recently decree law has been released and has outlined various provisions on the taxability, chargeability, transfer pricing regulation, conditions on free zones, carry forward and offsets, and has also included certain reliefs, exemptions, or I would say advantages to the taxpayer. So when we talk about reliefs and exemptions, definitely all are backed by conditions that need to be fulfilled by the taxpayer to avail those benefits. So here in this session, I'll deliberate on what all exemptions, reliefs are available for the tax groups and intercompany groups, where the topics would cover broadly, I would say in a tax group first, I'll talk about the condition because again, before knowing, without knowing the condition, how I can avail that benefit out of that. So condition and then what all can form a tax group or how the structure can look like, and lastly would be the, I would say, exemptions and a relief available to the taxpayer. So let's start with the tax grouping. So tax grouping, when we talk about tax grouping, it has conditions. So broadly, we have three conditions. So first condition talked about the taxpayer status and what to invest in the what already been invested or been invested in the member group companies. So when we talk about the status of the taxpayer, it says that member, including parent company, must be a resident judicial person and must have invested at least 95% of the shareholding or having 95% of the voting right, or, and what I'm saying is or is and, must be entitled for 95% of the profit, entitlement for the profit and the net assets. So here important to note that the condition says about the taxable person must be a residential judicial person. So it should be a judicial person, not a natural person. Must not be an individual, natural person. Because practically when we talk and we discuss the scenarios, we understand that in UAE, the investor says that all in the group, all companies are mine. And when you deep dive into the investment, you can find that they have invested. Means one individual, natural person has invested 100%, and in that group, what he considering for tax group, let's say 10 companies, and all in that they have 100% shareholding. But do that going to satisfy the condition of being or to form a tax group? So our answer would be no. So this benefit first condition will be satisfied only when there is a resident judicial person is there. So consequently, I would say where the investor or where the model is where the individual has invested must be moved to holding company structure to get this benefit, to satisfy the first condition, I would say. Because holding company then would further invest in the respective member companies to form a tax group. Second condition says that who can be a member of a tax group? Yes, it can say that, it says that the residential judicial person can form a tax group provided that exempted person or qualified free zone person cannot be a part of a tax group. So exempted person, we have already seen that exempted person include government company, government control entity, public benefit entities, public pension funds, investment funds. So all these will be considered as a exempt person. But they have given a one exception to that rule. They said the government can form a tax group where the government has invested 95% of shareholding in any of its subsidiary and having a 95% or more of the voting right, or is entitled to the profit of
95% in its subsidiary, then government can do the tax grouping, can go for a tax grouping. This is the only exception for to form a tax group which is available with respect to the exempt person. Second is a qualified free zone that cannot form a tax group. We all know that what are the conditions are there to be a qualified free zone person. So first is adequate substance. Still, we need to get the clarity. We are expecting some more clarification in the executive regulation that what would be termed as adequate substance. It's about the reality basically. It's about operation reality, backed by secretarial compliances, proper documentation, how it's going to go. Secondly, again, what would be the qualified income? It will come to us. Transfer pricing documentation, arm's length price rules, principles all need to be followed. If all these conditions are satisfied, then one can be termed as qualified free zone person. And yes, once they are eligible or when they are termed as qualified free zone persons, then they cannot be a part of a tax group. Third condition, it says that all the group members, including parent company, must have a same financial year. It cannot be a condition where the parent company is having a financial year starting from Jan to December, they are following calendar year. However, any of the member company is following some other financial year, which may be starting from April to March or maybe some other financial year. Another condition in the same, with respect to same financials, it says the financial year must be prepared on the basis of same accounting standards. Accounting standards could be IFRS, could be GAAP, or it could be any other standards that is globally followed internationally. So once these broad three conditions are satisfied on the 95% of the shareholding by the residential judicial person, and none of them is an exempt person or qualified free zone person, and all are following the same standard for their finalization of books of accounts, then they can form a tax group. Now I'm moving next. I think my slides would not be visible, but yes, I tried to portray what would be the structure that can form a tax group. In my structure, I have mentioned that the company A is a parent company, which is having a profit of 2 million. And under that, the parent company has invested in company B and company C, where they have a profit of 1.5 million and 1 million respectively. Further, there is a branches also there for the company A and company B. And there is another company, company X, with a loss of 2 million, where parent company has directly invested 50%. But yes, there's other equation is also there where the company C has invested 50% in company X also. So collectively, they are accumulating to 97%. So when we talk about the condition of 95%, it says about minimum 95% directly or indirectly. So going further, we can say that company A and company A, being a parent company, can form a tax group with company B and C, being it's minimum 95% of the shareholding, voting right and entitlement for the profit is justified. And further assuming that condition is none of them is a qualified, is an exempt person or the qualified free zone person, and all are having a same set of books of accounts. Further, when we go, can the branches also be included in the tax group? Answer is yes, because branches are always considered as an extension or a shadow of the main company. So it cannot be considered, they cannot be considered as separate judicial person. So yes, this has to be also be included. Further, since when we look at the equation for the investments, the parent company directly only investing 50%. However, when it club its investment through other company C, that is indirect investment, the total investment comes to more than 95%. Here it's coming at 97%. So that condition, indirect investment, is also being satisfied. So accordingly, company A, B, C, including branches, and along with company X, who is having a loss, can form a tax group. Further, in the on the screen, you can see that there is a one company, there is a free zone, qualified free zone person is there, who is having a loss of 1.5 million. Now, can this be included in the tax group? So our answer is no. But if any of the condition of being qualified free zone is not been fulfilled, is not been satisfied, in that case, it can be done. So last company QFZ having a loss of 1.5 million, if is not satisfying any of the conditions, that could be adequate substance, that could be earning unqualified income, or they willfully opting for the 9% tax regime. In that case, they fulfill the condition, satisfy the condition to be included for the tax group. Now question would come, what would be the benefit of losing 0% tax benefit? Why the company would do that? Yes, in my next slides, I will cover what are the advantages or relief and benefits are available. But in this slide itself, you can check. I have given the example where the company A, B, C, along with its branches, company X who is having a loss, company QFZ who is having a loss. If you form a tax group, then what would be the tax position? And if they would have gone individually, considering themselves as an individual taxpayer, then what would have been the result? So you can see that if they would have gone individually, they would have landed in paying the tax liability of 301,000. Whereas by forming a group, including both the entities, one is in a free zone having a loss, other company in mainland having a loss, satisfying the condition, will landed at paying only 52,000 only. So there is a effective tax advantage. Tax saving would be around 250,000 approximately. So this is just an example. In practical life, when we understand any business structure, we can evaluate that just having a company in a free zone and qualifying for the qualified free zone person is not always would be fruitful for the business as a whole. Yes, one can take an option, can evaluate by involving this part also, so that understand what could be the final tax saving. Now, I'll just take you to what are the advantages that I have evaluated. First advantage, or I would say benefit for having a tax group is a single return. The provision of the law says when the tax group is formed, then it will be considered as a single taxable person, and parent company has to file the single return considering the consolidated financials. So if I am forming a tax group, then tax return shall be prepared on the basis of consolidated financials. Second is, which will going to actually, when I'll have one return, the effective benefit, what I get is about the operational feasibility. We all are chartered accountants. We know that if we have to file 10 returns, and where other way around, other side, I have to file only one return on the basis of consolidated financials, then what's the operational feasibility, what's the operational benefit I can get out of it? And second benefit from having a single return is that, yes, there would be some administration cost saving to some extent. I can't say that the consultant will take less fee on the basis of consolidated financials, or they will take more fees on the basis of having an individual 10 returns. But yes, some tax saving would be there, some administration cost saving would be there by having a tax group to file a single return. Second benefit is that earlier cash flow benefits. As we seen in the previous example where the company A, B, C, X and QFZ has opted to form a tax group, and they are getting the benefit of tax loss adjustments without any restriction. So that will bring up earlier cash flow benefit. Yes, even if they go individually, the losses can be carried forward to n number of years. But yes, in a successive year, up to 75% of the income available can be set off. But if they form a tax group, then in the very same year, the tax loss can be adjusted with the taxable income, taxable profit available with the member of the tax group. So that is the second important aspect, earlier cash flow benefit. Third important benefit, or I would say advantage for having a tax group is no TP compliances. Understand, if in a tax group is considered as a one taxable person, So whatever is happening inside that tax group will not going to matter. So authority definitely will not going to come to you and ask you how you have sold the particular good at a X amount, however comparatively its market value is different. Because when you are filing a single return, government or revenue authority will going to check only that price where the tax group as a whole has sold or has booked the revenue while dealing with its related party. So in the example I can say, if I can say then a tax group, there's a company, holding company structure is there. One company is a manufacturing company, other is providing maybe a service sector by having a labor camps and providing a services to the manufacturing company, other is a trading company. So there are different companies are there in a one group. Once the group is formed, so whatever the price has been charged within the group will not going to impact or affect the price that has been charged outside. So government definitely will not going to bother, and there would not be any requirement to follow arm's length principle and transfer pricing documentation. So that would be a big escape, and this will definitely the family businesses will be more inclined to opt for this option instead of availing if they are into free zones or if they are not fulfilling any other conditions. Next benefit, next relief I have, there's a flexibility in addition and joining and leaving the tax group. If we look at the provisions, it says that group can be any entity who satisfies the group condition can join an existing tax group or can form a tax group, or anytime they can leave it. Definitely there would be a condition that will be going to come up, but yes, as a way path, it is doable. There is no restriction to join or to exit any tax group. This will be very good, I would say, parameter or aspect for the startups, for the, I would say, high capital intensive investment companies. Maybe we can say is the manufacturing unit, where initially when they set up for the initial period, they don't make profits because the amount of expenses are more than what the revenue they get, or I would say it is all about expenses. They only incur the expenses for the initial years. In those cases, if those capital intensive investment companies becomes a part of the tax group, that would be beneficial for the taxpayer as a whole of a whole group. Reason being, the benefit of the losses or the expenses incurred can be easily set off in the same year, in same taxable year, without bothering about the condition of carry forward and set off. Other condition says, if let's say one tax group is already there into existence, can other new company or a existing company can join it with the unutilized loss? Answer is yes. Yes, they can, because there is no restriction in joining and leaving the tax group. But question comes, if I am already in existing company, can I join an existing tax group when I have an unutilized loss? Yes, it can be done. Yes, unutilized loss. With the unutilized loss, the new company or existing company can join the existing tax group with the condition of carry forward and set off. So this can also become a part of a planning. Whether to include the existing company who is having unutilized loss into the tax group or not is all about evaluation, about the advantage that one can get. One more interesting thing is being provided with the provision which says that in case if tax group dissolves, what will going to happen to the tax losses, unutilized tax losses available in the during the time of dissolution? Again, benefit is been provided, which says if tax loss, if any company has joined before pre-tax grouping certain losses which was not been utilized, which was, let's say that amounts to 1,000 dirhams. After joining, definitely the tax loss would also be got adjusted. They will going to offset the tax losses which the new joining company is bringing in. So after joining the tax group, let's say out of 1,000, 800 dirham of tax loss is being adjusted within the group itself. And after adjustment, after certain period of adjustments, the tax group get dissolved. Then what will going to happen with the remaining 200 dirhams of the loss, unutilized loss that company A has brought in before forming a tax group? So they are given the advantage. They are saying then unutilized profit, unutilized tax loss that was there pre-tax grouping can be carried forward on an individual basis. So it's not like that. If I have joined a tax group, my tax loss, unutilized tax loss will going to be evaporate. It will going to just go into the veins. No. Any company who is bringing in the tax loss up to unadjusted, unutilized tax loss can be carried forward to the further years. One more important, I would say, advantage or relief available from the tax grouping is that it is very favorable for the structuring the business, where it says the member entities in a tax group can easily transfer their assets and liability within the tax group without giving impact or without giving rise to the taxable income. Only one condition needs to be satisfied for that, is that both the transferor and transferee should remain a member of a tax group for the period of 2 years from the date of a transfer. If this condition is satisfied, then whatever the assets and liability is being transferred will not be taxed. So this is a very favorable, I would say, point when anyone is looking to structure out their operation as a tax group. So these were the important, I would say, important benefits and reliefs available for a tax group that I have evaluated. Further, now we move to the further slide where it says, we can say that, okay, I had formed a tax group, that is fine. The benefits are available, that is fine. What will going to happen if I don't get involved, or I don't opt, or I won't be able to go for a tax grouping? Still, to certain extent, the benefits are available, that we can say the intergroup transactions with respect to loss transfer, with respect to asset movement of the assets in different conditions. The first condition says that when the taxpayer, being a residential judicial person, transfers asset and liability between the two companies, then they can avail the benefit of transfer of the loss, provided that either of the taxable person, either of the taxable resident judicial person must hold at least 75% of the shareholding in each other, or a third person may hold 75% of the shareholding in both the entities. Here important to note that when they talk about the shareholding, they said either of the company must hold 75% of the shareholding. That is fine. Second condition says or person. They use the word person. The person could be a judicial person or a natural person. So even if I say I am being a natural person, individual has invested 75% in company A and more than 75% in company B, in that case, both the companies A and B can transfer the loss with the condition that loss can be transferred and set off can be done up to 75% of the income available with the transferee. So what are the general rules? Yes, it's simple. Both the entities must be a residential judicial person, must be holding 75% of shareholding either by themselves or must be or third parties being involved to have such investment equation. When it has been done, subject to certain other conditions, the loss can be transferred from company A to B or from any of the identified companies, and set-off can be done up to the 75% of the income available with the transfer. Second benefit is talks about the qualifying group. So qualifying group, basically in this, it is more like same, it comes with the same condition where it says a taxable person must be a residential judicial person. But along with that, they include the non-resident who's having a P in UAE will also be covered in that. So any PE which is there in UAE, along with the judicial person, can do this transaction, which says that movement of the transfer of the asset and liability within identified taxpayers will not be subject to tax. Considering that the transfer has been done at a net considerable value, net book value. So consideration will be adopted or will be considered as a net book value only. So when the transfer has been done on the net book value, then definitely there is no point of coming up or finding any taxable profit or loss in that. What was my cost in the books at a book value, at the same price, same amount it is being transferred. But yes, condition has to be followed. Same condition will come up where either of the company is holding 75% of the shareholding or third person. Third person, again, I will emphasize on that. It will not be a judicial person, it can be a natural person also. So either natural person or judicial person holding at least 75% or more of the shareholding in both of the identified entities can help them or make them eligible to go with this transaction, and that grouping is termed as qualifying group. Along with the other condition is that again, it cannot be exempt person, qualified free zone person cannot be there. Then same financial year must be followed. Then accounting period or accounting standard, which on the basis of which this financial has been prepared, must be accepted, must be internationally accepted. It could be a GAAP, it could be IFRS. So once it will be done, then losses, transfer of the asset and liability can be done. Along with that, okay, now I'll move. So along with that, when we say that another condition about the restructuring, they were given again further relief is given while business restructuring is being planned or one is planning to do that. It says, firstly, who can do that? Here it says a taxable person, a resident taxable person, or non-resident having a P in UAE. Again, important to emphasize here, they are talking about taxable resident person. They are not talking about the judicial person. Here, the taxable natural person who is a resident can also participate and avail this benefit. So I can say this benefit, if the sole proprietorship concern is there, they want to go and I would say they are acquiring some business and going for the mergers. In those cases, this will be helpful, where it's saying that taxable person, resident taxable person, transferring its business or acquiring the business, then benefit can be availed. So I'll take you in details. Basically, there are 6 circumstances under which the restructuring would be beneficial and would be permitted. First condition is says when the entire business is being transferred to the taxable person, existing taxable person, or a person who is not a taxable now, but after this transfer will become a taxable person. Second condition says when not the entire business, part of the part business which is independent, for which financials would be independently available, operations are independent, and results can be independently disclosed. Independent business, if it's been transferred to the taxable person who is existing transfer pricing, or a person who is not existing taxable person but will become a taxable person after this transfer. Third condition, where a person transfer his business to either of to taxable person or non-taxable person, and after transfer, the taxable person whose transfer will cease to exist his business. Means its existence will not be there anymore after the transfer of business. So once these 3 circumstances with the 6 conditions is been done, then one can go to check the condition to avail the benefit of not being taxed, because relief is already there in the law. Here, benefit with respect to asset transfer of asset and liability at a book value will be considered, net book value. So again, no taxable income or loss would arise. So there is no tax position will come up. Second is that where, in the condition where any person, taxable person who's looking to acquire any business with the losses, tax losses, unutilized tax losses, again would give a big deal. Reason being, again, once it is acquired, unutilized losses would also be allowed to carry forward by the transferee, a new business. To understanding the gravity of this provision, where it is giving an immense opportunity and relief to the taxpayer. If they go for setting up or not setting up, they will go for acquiring a new business, they go for the merger acquisition deals, they can, if they follow or they satisfy any of these 6 conditions, they can avail the benefit, which will not go into consequence any tax on a transfer of assets and liability. And further, unutilized loss can be carried forward and set off at their disposal. So this is the benefit, or I would say advantage and relief were available for the intergroup companies. So here, with the end of this slide, I'll conclude my session. Thank you all for your patience, and have a very good evening. Thank you so much.
Thank you, C. Amit, for let us know the nitty-gritties and the tax planning aspects of tax group reliefs and exemptions. Let us have a big round of applause for our speaker, C. Amit Mehta. I would like to invite our EXCOM members, Sri Rishi Chawla, Dheeraj Ranasaria, and our Vice Chairman, Sri Harikishan Rakawatji, with Chairman to stage for felicitation. आप लोग जा क्यों रहे हो? Snacks box distribution after 6 o'clock. It's written in that coupon also. And once Manu is started, I believe that you will not move from your chairs. So be patientful and listen to the next speaker, because without that topic, this corporate law does not have any meaning. So respect the speaker's efforts and please have your seat. How many of you have gone through with this corporate law? बस 5-6 नहीं पढ़ा है. Good. Try to read it out. So our next speaker is CA Manu Pellerichal, and he is going to take us through, like I said, with the key component of the corporate law, registration and administration. Because without registration, implementation, or to whether business is required to register or no, that is most important aspect of this corporate law. And I would like to invite our EXCOM member, C. Dheeraj Ranasaria, to the stage for a formal introduction of Manu. थोड़ा ताली बजा दो.
थक गए लगता है ताली बजाते ही. Good evening all. As our previous esteemed speakers already focused on the various topics of the corporate tax, like taxabilities and the tax group, tax laws forwarded, but without knowing about the registration process and that administration process, nothing will be worked out. Like, you know your tax calculated, but you did not file the return on time, then penalty definitely will become. So to decode all these things, our registration process and administration process, we have between us CA Manu. CA Manu has a very well-versed experience in implementing of the VAT in the UAE, Bahrain, and Oman. He already conducted more than 250 seminars and webinars across the UAE, Bahrain and Oman also. He already had the various honorary positions like board member of associations of international tax consultants like more. So I request all of us to welcome CA Manu.
Good evening, everyone. I need my laptop, otherwise, even for me, some of the slides, yeah, still you can see me. It's always said, it's a challenge for any speaker to be on last, especially on such a day where just 7 o'clock, the match starts. What? My time is till 6:20, and what you can see on the screen is time. Exactly. When I said I called my uncle today, so I told him that, okay, on such a day, I'm the last speaker. Then I was, okay, I'm the last speaker. And thank you, everyone, the organizing committee, ICA Dubai chapter, for giving me this opportunity. Of course, keeping that, Uncle said, he's a politician. He said, the best speaker we always keep as the last. By keeping that in confidence, let me move ahead. Albert Einstein said, what is always constant? Everybody knows. Death and tax. Who can extend death? Very difficult, but at least doctor can a little bit extend, or at least reduce the pain. Who can extend the due date of tax? We, chartered accountants, can little bit extend, like not on 1st June 2023, can be up to 31st December or 31st March. Maybe 7 months or 10 months, we need not pay tax. We can structure it, or it may be as per their existing documents. At least, if that is not possible, if that affects your clause number or article number 50, that is anti-abuse rule, God, at least let us try for reducing the pay, tax liability, as per the regulation, complying with the provisions of the regulations. With this, let me go through my slides. Slides, I hope it will be visible for everyone. At least in online it is visible. Few seconds for me also to refer. Yeah, it is not visible here, but what I am going to discuss today is the registration, the tax administration and documentation, then some of the transfer pricing clauses where we have to comply with the law and need proper documentation, and calculation and settlement like withholding tax. 25 key issues, 25 key issues for consideration and way forward. Tax registration, since it is a session almost, we started at 2:30, still I'm here. We started at 2:30 and now it is almost 6 o'clock. So I prefer, let us make it little interactive. The law came last Friday, not yesterday, the last week Friday. And everybody might have read, even though it is not fully, you might not have gone through fully through the law, but at least you might have read here and there. And you might have attended some of the webinars or seminars. Today we have been listening for the other speakers. So I would prefer to make it interactive so that I can't see who all are in front of me because of there's no light. But to ensure that you are there, what is the effective date of tax? It is 1st June 2023. Who all have to register under corporate tax? If you register a company, if you have a company, LLC company in the UAE, should you go for a registration? Can we make it a little interactive so that I can make sure that you are along with me? Should we register? Yes, we should go for registration. Now, certain persons may be exempted from registration. And if you are an exempted person, it's already discussed who's an exempted person. Should we go for registration? No, unless authority recommends or give or provides through the cabinet decision. So some of the exempted people also have to register. What about individuals? If you are conducting a business. So that also the cabinet will give, the cabinet decision will show you, give who all have to register under this as a person who is conducting a business. Now, if you have a sole establishment, will you register that for corporate tax purpose as a sole establishment? Yeah, individual will be responsible for that. Now my question is, most of us, some of us are in practice, maybe consultancy firm or audit firm. What's the nature of legal structure of your company or audit firm or consultancy firm? Is it LLC? Anyone? LLC? Agree? LLC also there. Sole establishment? There. Civil company? Majority civil company? Agree? In the case of LLC, you will go for registration of that company. In the case of sole establishment, you will register the owner. In the case of civil company, individual shareholder will be liable for tax. That means they have to register themselves. So the responsibility comes to you on your individual capacity. However, you can submit an application to consider the legal entity as it is. So there are many things which we have to learn like this. Due date, what is showing there is due date for registration. What is the due date for registration? Sorry? Not announced, but what is said is that registered before the taxable person files the first tax return. That means due date is not declared. Probably it will come in 2023, we have to register. Cut-off date is not yet announced. Let us wait for the cabinet decision or the procedure related to that one. What's the registration threshold? Registration threshold? 375,000? No, there is no registration threshold. No registration threshold. However, there is a special clause of small business relief. Wait for the cabinet decisions to come. There may be a turnover limit related to that one. Let us wait for that. But there is no registration threshold. I am registered under VAT. Anyway, everybody knows VAT registration will not be considered for corporate tax purpose, but still in the market, a lot of questions comes related to that. This is another slide I prepared. I'm sure you can't understand what is written there, but I'll just go through this since in online also our members are attending. My question is, the previous speaker Amit has in detail discussed what kind of companies can be considered under one tax group. Now my question, two companies, A and B, they are not juridical persons. Suppose two entities, or they are not juridical persons, maybe civil company, unincorporated partnership, or anything. So they cannot be considered for the tax group. If both are residents, then only we can consider for tax group. Both have to be residents. If any one of them is an exempted, we cannot make as a tax group. Any one of them as a free zone, qualifying free zone person, we cannot. Both have the same financial year, yes. If both are having same financial year and both are using the same accounting standards. What, as per the law, what is accounting standard we have to use? Anything internationally accepted accounting standard we have to use. So in this case, if all these conditions are satisfied, and very important is that, as he explained, 95% of the share capital, voting rights, profits and net assets, one company has to hold it, other. Why I am reinstating this one? This tax group is not cup of tea of everyone. Because the company itself has to hold 95% of the shares in the other company. For the family large groups or some multinational entities, okay, it's working. Otherwise, by considering the normal business structure or legal structure in this UAE market, very rare chance to get this opportunity to group. If you can group it, what is next? Check whether company A is holding 75% in company B, or company B is holding 75% in company A, or there is a common shareholder who is holding more than 75% in both companies. Then you can use the transfer of loss option. So in the case of group, while doing the registration, check whether 95% A is holding B or B is holding A. But in the case of transfer of loss, it will be separately registered, but 75% of common shareholding is enough. It doesn't mean that the A has to hold B or B has to hold A. Even the third party holding 75 or more will be sufficient. Now, tax returns. Due date for tax return is within 9 months from the end of the tax period. And I have made a tax return format also. I'm sorry, it may not be visible for you. If you indicate, I can share with you later stage. I considered all this deductions, add back, carry forward set of tax credit, and all this are considered, but I can share this slide with you later. So since it is not very clear, I'm not explaining in detail this one. Financial statements and tax audit. What I suggest, or even what I prefer, I'll go to the last part, the 25 key considerations. which you have to keep in mind. So that it will be a summarize. You can collect the points whatever already spoken by the other speakers. You can recollect whatever you have read or whichever you have heard from your friends also. Then let us recollect those points and discuss further. So that will be an interactive session also. I prefer that one. So I'll go to the last slide or the key consideration. Can you go to the, it's going? Key issues. Here, I'll be asking question. I expect you to answer. Number one, it's already discussed, I think. The sole establishment and unincorporated partnerships. It has to be registered under individual's name. The second point, civil company, that also I discussed just now, so I am not repeating that point. Third point, transactions between free zone and mainland. The transactions between free zone and mainland. The point related to free zone, what are the applicability of the tax? What is applicability of the tax in the free zone? 0% for the qualifying income. For the non-qualifying income, 9%. We have not received the breakup or the conditions of what are the qualifying income. Once it is released, suppose I am having 500,000 qualifying income and 500,000 non-qualifying income. I need not pay tax for the non-qualifying income. Whether I will get 375,000 exemption for the non-qualifying income? Doubtful. When you read the law, it is said that qualifying income 0, non-qualifying income 9%. Whether the same company will get both, it's also we have to wait and see. So if you are a free zone and earning only non-qualifying income, 9%, doubtful whether you will get that 375,000 benefit. As per this, the reading of this law, we will not get. So choose wisely. You have an option to choose the normal corporate tax option also. That is 9% option in line with the mainland activity. There you will get benefit. So when we are advising the client or choosing for our own purpose, you should choose wisely, plan it accordingly. And there are many companies, free zones, which are flexidas or even not being operated from the free zone, even though they have an office space and license, everything. So whether PE will be shifted to mainland. There is a chance, and that also has to be looked into. So that is my the scope of qualifying free zone. So I heard when I came in Dubai, after that all I heard that qualified chartered accountant. So this terminology I haven't heard from India. How I came is that when I came here, I know some of my friends unlucky, so they could not clear. So when I met them, they said that they are working as a chartered accountant here. So chartered accountant? Yeah, chartered accountant. So I used to say qualified chartered accountant. So that terminology became very important for me once I came to Dubai. In the same way now, qualifying pre-zone person. So let us get that qualification. Let us digest it. Let us wait a little bit more time to get exactly what is the condition, how many papers are there to get that qualification. What's the tax holidays? Just a question, whether this qualifying income for the qualifying free zone person in the qualifying free zone is only for the designated zone or only for mainland also? Sorry, not mainland, and not other than designated zone also. There are around 50 plus free zones and 40 plus free zone authorities in the UAE. Whether designated zone only will get this benefit or the other free zone also? All. By looking at it, all. They didn't say specifically. So the free zones, it is not mentioned about as in the VAT law. So we can accept that it is applicable for all free zones. It is applicable for all free zones. And in this case, the public consultation document, let us not connect with that one. I personally think we should ignore the public consultation documents, because this public consultation document was released only to get an opinion from the public. From that, when we read the law, there are some words already removed. For example, individuals conducting real estate activity which doesn't need a license. That word is removed. So now we have to wait for the cabinet decisions to come to what extent the real estate activity conducted by individual will be applicable for under tax. So let us ignore what was there in the previous regulation. I mean, cabinet, public consultation document. In public consultation documents, there were a lot of, around 10 to 11 points were given, importing from free zone to mainland, and related to that one, many. You can keep in mind, but before applying that one, let us wait for the cabinet decision related to that. There are tax holidays in many free zones in the UAE. So the tax holidays are in some of the free zones, it is up to 50 years. So up to 50 years, you can get that benefit. So we have to check. Once the regulation comes, I'm expecting the cabinet decision may disclose what are the free zones, to what extent this tax-free holidays are available. Then accordingly, we can get the benefit. It will be very difficult practically to go through the regulations of guidelines of all the free zones and understand where it is applicable, where it is not applicable. Let us wait for the list to come. Another important point in the free zone is that substance has to be met. Just to recollect, economic substance regulation at least. Let us keep that in mind, whether you are conducting relevant activity or other than relevant activity. But let us expect the cabinet decisions to come. What is substance for a free zone to maintain in their free zone activity itself? And now, next point. Tax grouping challenge, I discussed already, this 95%. The different conditions for corporate tax group and VAT tax group, VAT group and then corporate tax group, it is not at all connected. Market is having an understanding that since I already registered under what group, it can be taken as it is. That is not right. This general anti-abuse rule. It's the key element here which came into effect already before the law, before we got the law. So structuring, if you are advising the client, make sure that you are not violating or you are not falling under abusing the law under Article 50 of the regulation. Changing the financial years, check. I always suggest keep it as a regular what you are doing the business in line with that one, and let it be in line with your documents, that is memorandum of association. And if it's not in line with that one, and if you are changing, it should not be for the purpose of reduction in corporate tax. So you should make sure that you are not violating the law. 12th point, need of separate audited financial statements for all entities. If it is registered under group, consolidated financial statement. If it is registered, not registered under group, standalone financial statement is must. When we know for the different purpose in the UAE, companies started for different purpose, like for maybe for the location wise, Emirates wise for different reasons, or for the visa purpose or any other administrative purpose. But separate financial statements are not even maintained in many cases. People say, I have branch, my main office is in Dubai and I have branch in Abu Dhabi, Sharjah, but it is not actually branch. Sometimes they open separate license and they are the different entities. Even though you call as license, check the legal structure and ensure that if it is a separate legal entity, make sure that you are maintaining separate books of accounts. Participation, exemption, consideration, we already discussed, the previous speakers already covered that one. Recollect it, very important. Then 14th point, principle of effective management and control, poem. Place of effective management. So this is very important. Many people have headquarters here and having business in other jurisdictions, maybe for tax benefit purpose or otherwise also. If you are doing if the poem is shifted to UAE, you will become a resident in the UAE. Point number 15, relevance of economic substance ESR filing on implementation of corporate tax. We had to wait and see to what extent it is relevant. Next point is corporate tax deduction for irrecoverable VAT. Can we deduct the VAT paid to the government as an expense? Sure. Can we deduct the input tax credit of VAT? Irrecoverable. Why can't we charge as expense the VAT expenses? Where it is said no. Corporate tax paid is not an expense. Think of it. Carry forward option of net interest expenses. Carry forward option of the losses. Interplay between VAT accounting and the rules with the corporate tax law is very important. For the purpose of VAT, the transactions has to be recognized based on the clauses under VAT, but here it is different. So we have to reconcile these two. Next is this. I'm just listing and summarizing because it's already discussed by the other speakers. I want you to recollect it. Next point is the last slide of this key issues. No personal income tax. That's why even for the connected persons, the transfer pricing is applicable. That the other speaker discussed earlier. If you You are a connected person. Who's a connected person? Maybe an officer or owner, a director, and any payment made to them as a related party transaction. It has to be at arm's length, at market value. Point is, the managerial remuneration. It has to be at, example, managerial remuneration has to be at arm's length. It has to be at market value. How we can decide or arrive that one? Can we sit together and decide what is our management fee? Most of you are withdrawing as a management fee. Let us make a structure. What should be the benchmarking and everything? No, it's not practically possible. It should be, depends upon your business, whether you are a consultancy business or you are into trading, and depends upon the contribution what you are giving to the business, whether it is at arm's length. If you are appointing someone else, whether you will give the same amount or not. If a management fee is 50,000 for last couple of years, suddenly from 2024 onwards, if it is 200,000, tax planning is not easy. Let us not plan like that. Now it is very important drawing, even some of the people discuss, I don't know, my business is such a large organization, especially since it is UAE, it is managed by family members. We don't know who all are the related parties, the connected persons. It goes up to the 4th generation, even by borrowing the words of Manoj, 4G. In UAE, it reached 5G in telecom, but in tax, it reached to 4G, 4th generation. So here, if we don't know who's your connected person, who's your related party, make the family tree first. So now, earlier we used to see the company profile. So in the company profile or in the private profile, you should have the family tree also of the organization to ensure that it's a related parties and with whom you are dealing with. Suppose you are in a big, large group, you don't know with whom you are dealing, whether they are related party or not. Later you knew that they are related party. Of course, the disclosure is required, but if you don't know whether he is a related party or not, definitely the transaction will be at arm's length. You need not worry about it. Only the disclosure requirement will be required. If you don't know, how authority will come to know? Depends. Depends. And only you have to justify. Borrowing the words from Manoj, you have to justify. Carry forward option of the net interest expenses, real estate income earned by individuals, that point I already discussed, and by the last point of this category is that you ignore the public consultation document. You can just review, just keep in mind, but don't apply it as it is now. Now let me, how much time I have? 10 minutes? 5 minutes. Okay, let me cover some other points. Sorry, it is very slow. These are the financial statements. So in the financial statement, it is who should Who should maintain the financial statement? Every registrant has to maintain the financial statement. If it's an exempt person, you should prove the documents. Your documents should prove that you have sufficient documents to prove that you are doing an exempted supply. I'm just covering the transfer pricing key highlights I thought of discussing. Today I'm not discussing that one, but I'm just covering what are the documents required as per transfer pricing regulations. This is very important clause which you have to keep in mind. Very interesting and very helpful regulation, that is 34 subsection 10 and 11. Suppose you have filed your tax return and the authority found that you have not done the transaction at arm's length. It will make an adjustment to the amount you disclosed. What will happen to the other taxable person? The corresponding adjustment will be done by the authority itself. It is not normally seen in other part of the jurisdictions. This is very helpful. That's why it always say that the UAE's regulation is always supporting the business to entities to do the business. So that is very helpful. That is one of the very interesting clause in this. In the same way, your transactions, if there is any adjustment done on arm's length price, it brought into the arm's length price in the other jurisdiction, you can request the authority to make the same adjustment. That's only with the permission of the authority it can be done. My point is, what are the documents to be maintained under transfer pricing? Every entity has to, which are falling under transfer pricing, wherever the transfer pricing regulation is applicable for them, arm's length principle has to be maintained by them, then they should maintain proper documents to justify their transaction with the related party. So, along with your corporate tax return, you have to submit a form to the authority similar to 3CEB in India. You have to submit. The cabinet decision will disclose which are the categories of entities or taxable persons to submit this form of transfer pricing documentation. However, there is another set of requirement, that is the master file and local file. This master file and local file have to be, my files have to be maintained by the taxable person where TP is applicable and need to be submitted to the authority within 30 days from the date of the notice or any other date provided by the authority. So, we have to maintain basic documents, supporting documents, along with the tax returns. If you are forming part of that category, you have to file. And you have to maintain master file and local file. And if you are falling under the category, you have to maintain it, and then if authority requests or asks, then you have to submit. Otherwise, you have to keep it for how many years? 7 years. So, this is a flow chart I prepared, but it will be difficult for you to go through that. But just 2-3 slides I would like to discuss with you. What is withholding tax? What is withholding tax? If any, for example, suppose from India, if a company is getting a service from UAE and we are making any payment to the authority, to such service provider, a specific percentage of tax has to be deducted and paid to the authority. What is that percentage as of now? 0. Authority or through cabinet decision, it can go above 0% in future. Later, if such percentage comes, And if such payment is done to the authority, then under 44 and 45 of the regulation, whatever payment is done to the authority, you can get a tax credit for that person, for that non-resident becomes a taxable person in the UAE. Once you file the return, you can claim the tax credit on the withholding tax credit you can claim. And if that amount is more than the tax liability, you can go for a refund. So that will come once the 0% changes to another rate. And people are having little confusion on that one, and some questions was discussed earlier. That's why I was highlighting that one. It is applicable for the people, non-resident, who already paid withholding tax. Once becomes resident, we can claim the tax credit already paid to the extent of tax liability, and the remaining amount we can go for the refund. He can go for a refund. At the same time, tax resident, once we file the tax return, he can claim the tax paid in other jurisdictions to the extent of the actual tax liability. The excess, if any, we paid outside, we cannot claim the credit, we cannot carry forward as well. These are discussed previously. So I'm moving to the last slide. Way forward, what we have to do now? Let us, in 1 minute, I'll be closing the session. Registration, wait for the cutoff date, wait for the cabinet decisions to come. Documentation, start preparing not from the due date, now itself, and make sure that you are having proper documentation, especially on transfer pricing. Now itself, have the proper documentation, agreements, contract, supporting documents, everything has to be maintained properly. You have to justify your transactions. Then clarification, there is if you don't know that, if your law is not clear, any part of the law, then we can look for the clarification like how we are doing in VAT. And then the tax return on the due date, what is this? Within 9 months from the end of the tax period. Corporate tax liability also we have to pay within 9 months, not one tax payment. And then refund, if it's applicable, then we can ask for the refund. And self-assessment, let us do. Let us not wait for the authority to come for an assessment. Let us comply with the regulation. With this, I'm ending my session. Thank you so much. Thank you so much for this opportunity to the managing committee and to everyone who are here sitting from 2:30 onwards. Thank you so much.
Thank you, Mani. Thank you, Manu. It is nice closer, we can say, on the registration and procedures and what we should do. Because not only registration, we need to ensure few more things. Well, let us have a big round of applause for our speaker, CA Manu. May I request our chairman, vice chairman, Dheeraj and Rishi to stage for a felicitation to Manu. The ones who are not registered and couldn't get that coupon, they can register with Palak and get the coupon. This is the end of the session, and really thankful to all the speakers, participants, and members, ExCom, past chairmen for their kind support as always. Let us thank our sponsors, title sponsors, Saudi German Health, principal sponsors, Pan Emirates Home Furnishing, AGMC, Tele, Lulu, IFCO, platinum sponsors, Emirates Chartered Accountant Group, WMS, CloudSook and UHY James, FMCG partner, Aktia, Media partner, Khalij Times. Institutional partner, Delhi Private School. Banking partner, Bank of Baroda. And magazine partner, Finance World. Good night. See you soon in next event. Thank you very much.